Well, guys, it's time for that update once again. What is going on with leveraged debt and retail traders? In today's video, we take a look at how it could be possible that we are 4 times larger in terms of single stock leverage than we were last year at very similar prices. And to make matters even worse, yields really haven't gone down that much. With copper spiking a lot based on a 50% tariff from Donald Trump and Bitcoin potentially poised for a massive breakout, there's a lot to discuss in today's video. So join us as we cover stocks, commodities, and cryptos to break it all down together. Guys, this is not to be missed. These stats will absolutely shock you. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the big flows, and of course, that big one, debt. What exactly is retail up to? If it's your first time here, remember to subscribe and smash that like button if you love markets like we do. But let's kick things off here with taking a look at the latest margin statistics. Now, you may already be aware if you've watched this channel for a long time that I often go back and have a look at margin every so often to get the latest reports. And one of the reasons is because before any great global kind of crash, we generally see people taking on too much debt. Now, you may be aware based on credit cards, based on maybe cars or other things, that people are certainly leveraging themselves up right now. But one of the things that I really want to mention here was that we have now almost approached an all-time high, and I believe with the latest data that's coming up very soon, so we'll have this on the channel, we will go to an all-time high in regards to FINRA margin statistics. But this doesn't even show the full encompassing of the debt right now in these markets, because when we take a look at single stock leveraged ETFs, this has been growing at an astronomical pace. And considering that the market is basically at the same price as it was in 2024 near the peaks, yeah, you'd be wondering, how is this possible? And it turns out that it's mostly us. Retail traders are going ballistic on single stock leveraged ETFs, particular things such as Hood leveraged, PLTR leveraged, and many others. And while inherently this is, of course, exacerbated gains, ultimately it's going to be, rug pulled by Wall Street. They love to do this eventually, and it always happens that way. And it reminds us a lot of 2021. If you were trading during that time, you would remember the hyper stocks, which were moving 10, 20% on a session, and then ultimately they all blew up. But at the same time, remember that was not really levered in the traditional way of a leveraged ETF that's now becoming so normal. This is allowing retail investors and traders that don't necessarily know what they're getting into basically make bigger bets on the markets. And it's a cause for concern as this now rises up, and I would expect it to continue even more crazily into the second half of this year. So why is this important? Well, we've seen kind of a switch in markets when it comes to what's going on right now. We've gone from everybody climbing the wall of worry to now everybody being FOMO. And as you guys know, there's a trend line that's coming up that's pretty important for the markets. And we've just seen new tariffs kind of starting to be implemented, such as that 50% tariff on copper. Now, markets haven't freaked out yet because I guess they don't really believe it's going to stick based on some previous knowledge. But at the same time, if it does stick, remember, this is going to put huge shockwaves through the market. Copper is very important to global growth, and it is often seen as Dr. Copper, the kind of read of strong markets or weak markets. So it's kind of being manipulated almost at this point. Another thing that's kind of worrying and concerning here is this post from Mike Zaccardi, courtesy of Goldman Sachs, which basically shows that mostly we are getting a huge amount of momentum switch. We've gone from super low momentum, super basically risk off, to super risk on just in the last 3 months. And this will come as no surprise. We're in a V-shaped recovery, and obviously strength does continue generally to bring strength. Now, one of the reasons for this has also been buybacks. Take a look here. The S&P 500 announced buyback plans. Initially, we thought this was going to be a bumper year of buybacks. Then it dropped off during that whole tariff stuff, and then it came back big time. And you can see here that buybacks have been where a lot of companies have been putting their money. And the main reason is because they're not investing in the future. A lot of them aren't doing that. And this is causing, of course, inflation, or in terms of inflated growth more so, inside the stock market. We know that buybacks have been artificially one of the main reasons propping up the US market for years, along with debt. And of course, in this case, it's back here at this point. So everything's all good. Well, I guess, in many ways, I guess we would look at this and say, okay, things are looking pretty good. Technology is leading. Defensives have, of course, been dropping off. And other than the last 48 hours, so 48 hours ago, we got a little bit of a spike in defensives. We've generally been seeing tech, semiconductors, and hyper stocks leading the charge. And that is usually a pretty good sign. In fact, I went and posted over on our LinkedIn or my LinkedIn over in the links in the comments down below. And I posted some of the things that you generally want to be looking for in strong bull markets. Now, if you're ever looking at strong bull markets in the future, let's say we pull back, we end up getting back into another strong bull market, then of course you want to be checking out this type of stuff. Links in the pinned comment down below, and of course in the description if you want to follow me there. I'll be posting a whole bunch more on psychology of markets and of course things to look out for, helpful tips. So definitely follow us there if you want to. Now, what about S&P and the expectations of the street? Well, we know they're generally wrong. Of course, we've seen this already this year. They came out kind of going for 7,000, 7,200 this year. Then they pulled it back down to about 5,600, 5,500 during the tariff period. And now everyone seems to be back at around 6,600 by the end of the year, based on the latest survey results and latest PE ratios. So will that be correct? Well, one of the things about this market has been that we've rallied into the period of time that you generally rally into. And then we tend to see a slowdown or pullback or sideways style market. And this makes some sense. If you think about it, Christmas in July kind of goes through to the middle of July. Then we kick earnings season off. The 15th of July will be worthwhile watching. And valuations are starting to get high again. So we're going to need to see that the earnings are coming along with the market's expectations post, of course, these tariff implementations. We're also going to need to see a lot to do with these big companies, Nvidia, TSM, Meta, Google. How have they performed? Have they done enough in terms of bringing AI growth to America? And have they sacked enough staff as well? Because, of course, this is going to be what the street is looking at moving forward in terms of becoming lean, mean, trim AI machines. Will that end up causing the markets to continue to rally higher? Well, it is an expectation, but we've got to remember that year threes of bull markets, especially after what we've seen, especially when we consider that there's some pretty big tax policy switches and all things that are going on right now with the US government, that generally brings us to a sideways style market. Kangaroo in many ways, up, down, up, down, up, down, up, down. And we've just had one of the strongest recoveries ever recorded, which is not a bad thing. And of course, this often brings what you would say is some form of consolidation. It happened in 2020 and it could be happening now. In fact, it's pretty common as well when you look at presidential years, how this market is kind of playing through. And you can see here that we're getting to the stage now where the rest of the year is less likely to be super bullish as everybody goes ballistic, but at the same time, leverage is up big time across the board. That's FOMO right there, guys. Advanced decline line is up, which of course is a decent sign for markets. US dollar is down, which is making the US markets look comparatively cheaper if you're from overseas. And of course, we've talked about this in our previous video, whether the dollar is now starting to baseline for now. And we've even seen large cap stocks starting to break back up that have been, in the doldrums. These are ones that have formed bases for a long time, done nothing, and they're kind of like those value plays. So when you see the value play market pick up, you see the Russell 2000 pick up, that's a broadening of the market rally. And so far, we've been fixated on the semiconductor